stock at the right time.
Hello and welcome to Bloomberg Quint Live, and you're watching Trendspotting. I'm Shraddha Bhavla. Good morning, Agam.
Good morning, Shraddha. I'm Agam Vakil, and in the next 30 minutes, we deep dive into specific trends in the markets and draw key takeaways and their implications for investors. First, the headlines. Markets hold on to early gains. Nifty trades about 10,550, led by metals and IT. Broader markets in line. Nifty Metal is a top sectoral gainer after commodity prices rise to multi-year highs. And Fortis Healthcare gains as much as 5% before settling near the 150 rupee mark after IHH and the Berman and Hero Enterprise combine revises their offer for the company. And it is an earnings-heavy day today with TCS and IndusInd Bank coming out with their fourth quarter results today.
All right, let's take a quick check on where the markets are trading at this hour. The benchmark indices have held on to their marginal gains that they've seen. The Nifty continues to hover around the 10,550 mark. However, trading in a very narrow 20-30 odd point range since morning. The bank Nifty is also fluctuating between gains and losses. Not much to talk about the mid cap and the small cap indices either, but once again continuing to trade in the green territory. The broader markets, the market breadth remains positive, however, with the advanced decline ratio at 9:7. The only space really that stands out right now is metals, and we'll talk more about that. But Agam, any individual names that you want to talk about?
I do actually want to address what's going on with Merck, because you've seen a sudden spike in the last 15-20 odd minutes, and Merck India has advanced by as much as 15% now. So we're looking at a lot of strength there. And of course, I also want to address Phoenix Mills. We've had Motilal Oswal initiate coverage on this particular stock, and we've seen a buy rating coming in. And perhaps on the back of that, we're looking at the stock advancing by as much as 5.8%. This is usually not a very liquid stock, but we have seen an increase in terms of volumes in today's day of trade. And Tech Solutions is the other counter from the mid-cap IT space, which also takes over, and that's also advancing by as much as 5.8%. And as you can see there, we're looking at a little bit of an uptick in just the last half an hour or so. So substantial strength coming in there as well. So these are three stocks that I want to focus on, Shraddha. But what else are we looking at with respect to trends today?
Agam, metal stocks obviously deserve a mention, especially after the kind of global party that we saw overnight as far as base metals are concerned. Nickel rose by about 7%. Aluminium prices jumped by about 5.5% on LME. So look at all the aluminium plays today. Hindalco, Vedanta, Nalco, all of them up about 7-8 odd percent. Hindalco, Vedanta, of course, both of them the top Nifty gainers. In fact, Nikki from the research team has pointed out that Nalco is the most sensitive to aluminium prices, where every 1% change in LME aluminium prices impacts its EPS by about 5% or so. So Nalco is the one that we're watching out for as well, up 8%. On the other hand, you also had the crude oil Brent, which crossed 74 now. That's at a 3-year high. So not surprising to see that ONGC has run up about 1.5% or so. On the other hand, you have shares of OMCs which have come crashing down. You have BPCL, HPCL, IOCL, all the three OMCs dragging the Nifty lower. Sharp cuts of over 4 to 5% for each of them. MRPL has also lost about 4 or 5%. And remember, there was a CLSA report also earlier today on oil and gas, where they have actually maintained their sell and cut target prices sharply on all the three listed OMCs. That apart, remember, the defense stocks also have been seen increased activity of late. So you look at Mishra Dhatu Nigam. Now that stock is on an 8-day winning streak. In fact, today also it is locked at the upper circuit, and it has risen as much as 82% in just last 1 week. Of course, you had a news flow related with respect to MOUs and defense orders as well, but 82% in 1 week. Bharat Dynamics is also trading at a record high. And then you also have travel companies like Safari Industries. Now that has hit a fresh high. Now this company is a manufacturer of travel goods, and remember all of this week we've seen hotel stocks rally on the back of a strong holiday outlook. So Safari Industries has done well. We spoke to VIP earlier today, strong management commentary coming from there also. So VIP shares also advancing by about 3.5% right now. All right, so let's move on and tell you what we have lined up for you on this earnings special edition of Trend Spotting today. First, we will discuss the street estimates for IndusInd Bank's March quarter and expectations from the March quarter as a whole with Lalitabh Shrivastawa of Sharekhan. And then we will put the spotlight on what the market is expecting from the cement sector as we connect with Binod Modi of Reliance Securities. And then finally, we will get in touch with the management of HDFC Standard Life to discuss the key highlights of a strong March quarter. We will cover all of this in the next 30 minutes. All right, IndusInd Bank will kick off the earnings season, at least for the banking sector today. The bank is expected to maintain its steady growth trajectory in the fourth quarter as well. What is the street expecting? Let's get an analyst view from Lalitabh Shrivastawa, the AVP for research at Sharekhan. Good morning, Lalitabh. Thank you for joining us. Let's start with your estimates for NII, PAT and loan growth for this quarter, and also just want to touch upon the fact that NII growth for IndusInd Bank has been coming off a bit recently. Is this only attributable to the high base effect? Because otherwise NII growth has continued to remain about 30%. What is the kind of number we could expect this quarter?
Yeah, hi, good morning. Thank you for having me. So for IndusInd Bank, what we are expecting is we are expecting somewhere around 2,000 odd crores of NII and a PAT of somewhere around 960 odd crores. So that should be around 18% and 28% growth on NII and PAT front. Interestingly, now that you have brought the declining trend, yes, some aspect is due to the higher base effect. Also, it will be interesting to note that in this quarter as well, we are expecting that IndusInd would continue to outperform the banking industry, and we are expecting around 25% loan growth for this quarter. That said, I think the most important thing that will be looked at during this quarter would be, first of all, if there are any divergences, because just in December the RBI audit, or rather early in this quarter RBI audit was over. So in case if anything is reported by the bank, that should be something that will be looked out. Secondly, it has a significant, gems and jewelry business, even though it has, given a statement that, it has a very small exposure, two-digit exposure as per the management. Still, how things pan out in that front and what is the management commentary on that, that will be something also very keenly looked at. And asset quality, I think that is a very key differentiator for a bank like IndusInd Bank, because I think that will be something that will be very keenly watched even in this quarter, how that pans out. They have had a very steady kind of asset quality performance with credit cost somewhere around 14 to 15 basis points. I would expect a little bit of jump on that, so somewhere a couple of basis points jump on that, but I'll be overall happy if that is contained south of 20 bips.
So you don't think that the street will look at any marginal rise in gross NPAs as a negative, because we did see a marginal uptick in bad loans in the previous quarter as well, where gross NPAs have jumped by 8 basis points. But like you said, you're watching out for delinquencies in the gems and jewelry book of the bank, and also assuming that they have a very small restructured book and a relatively smaller exposure to all these NCLT accounts. RBI's February circular, etc., is not something that would have a large bearing on the bank's asset quality.
Exactly. They have a very small portion of restructured book. So a very significant impact of that is not envisaged as of now. And at the same time, while you say that 8 basis points addition in gross NPAs was there, we'll have to see that in perspective in terms of how the whole banking system per se is going to perform this quarter. And I think in contrast, IndusInd would be is expected to be continuing its outperformance.
Lalitabh, what sort of a divergence would be really alarming for IndusInd Bank?
I would not like to comment on any particular number as such, but in case if there is no divergence reported, I think the markets and the market participants will take a sigh of relief on that.
All right, but Lalitabh, all these positives, especially with respect to IndusInd Bank's asset quality being relatively better if you compare it to even some of the private sector banks for that matter. But do you think all of that is already reflected in the current prices that it trades at? A record high price to book ratio of 4, much higher than even HDFC's 3.9 if you look at an FY19 basis based on the Bloomberg numbers. So does it really leave any room for stock prices to move any further from here, assuming that IndusInd today does meet analyst estimates?
Yeah, so that's a very interesting question. I think that at this point of time, or in fact in any point of time, market participants are always looking at stocks which are outperforming the industry, which are growing in a very strong business direction, and at the same time the management and the overall running of the company is something where you can put your trust on. I think all these factors would continue to be with IndusInd Bank. So I believe this would continue to be investors are going to look at it in a long-term perspective and look at it as a growing franchise.
Okay, Lalitabh, we leave it at that. Thanks for joining us and giving us your expectations on IndusInd Bank. We will be watching out for those numbers, which I suspect will be out sometime late afternoon, Shraddha.
1:15 is the presser, so before that.
All right, there you have it. So with that, we move on and address the cement sector. So we do have ACC, which kicked off the earnings season for the cement sector with a strong set of numbers for the March quarter. But with continuing pricing pressure, how are the other players likely to perform? Let's get an analyst view here. We have Binod Modi, senior analyst at Reliance Securities, joining us. Hi, Binod. Thanks for joining us. Good morning. Let me just start off by asking you about what you made of the ACC's quarterly numbers, and can that be taken as a trend with respect to expectations for the other cement companies as well, especially in the markets that ACC is present in?
Yeah, in case of ACC, there has clearly been, number, it's been quite strong. It's a 24% kind of EBITDA growth. That's really been strong. But in case of ACC, that's one thing we need to consider much upon the realization front. I think unlike the expectation of, sequential dip, ACC has reported an improvement of realization sequentially by about 1.2%. So that is clear, differentiating factor in case of ACC. So higher realization is completely because of higher contribution from this premium segment products. It has grown to an extent of 13 to 14% of total volume. So that has been the prime reason for higher EBITDA that I feel.
Binod, overall for the cement players, I'm not just talking about ACC but cement players in general, the e-way bill introduction has seen most regions pushing for price increases from April onwards. But what is the extent of pass-through that you think will actually happen, and do you think the recovery in cement prices seen in the month of April could actually stay?
We have seen that there has been a substantial increase in prices in select pockets. if you talk about the southern region where prices corrected by about 4 to 5% sequentially in previous quarter, we have seen a substantial uptick in the month of April so far. And interestingly, the prices are more or less being sustained as on days, because there were some apprehension in the beginning that prices may not sustain and may get rolled over in later weeks, but it didn't happen, right? So I can tell you this AP Telangana, where prices have improved from 270 rupees to 315, 320 rupees. So the prices are sustaining as on those. So that is the thing. It's happening, most of the pockets, even the northern part and eastern region, we have seen certain kind of price improvements. So I believe we should not see any meaningful decline, at least in next till the onset of monsoon. So that would aid, cement industry as a whole in terms of profitability for FY19.
But are these higher cement prices really adequate enough to offset the higher input costs, the power and freight costs, which have moved up significantly higher since Q3 as well?
So if you look at overall cement realization, there has been absolutely no growth in realization in FY18, right? And whereas we have seen 20-25% kind of increase in petcoke prices in last 1 year. So certainly, 15-20 rupees price of increase, that won't be helpful to the cement industry. But still, it will add industry to maintain. And at the same time, we should not forget that utilization are improving every month for the industry as a whole, right? So that will also add cement companies overall to save on additional overheads. So yes, 20-25% kind of 15-20 rupees kind of price improvement plus utilization improvement, that both altogether will help cement companies to witness better profitability in FY19.
Okay, Binod, thanks for joining us and giving us your outlook with respect to what we can expect from the cement companies. We will be watching out for more trends, especially after the kind of pricing pressure we've seen for a lot of these companies. But moving on, it has been a strong March quarter for HDFC Life with about a 24% jump in its profit numbers. And Bloomberg Queen's Ridhima Saxena caught up with the Executive Director and Chief Executive Officer Vibha Padalkar to decode the earnings for the quarter gone by in further detail. Here's a slice of that conversation.
If you look at the scale of the renewal, so it is high. So if you're looking at 12,000 plus crores and next year, increasing, so just the base is high. So a 13% growth. If you, instead of looking at just per se the renewal premium growth, I think really just what we discussed about in persistency, that is a more telling metric. I'll also explain simply in terms of sometimes we have a premium paying term of 5 years. Cover is for 10 years, but PPT is 5 years. So when you look at renewal premium, it looks like whatever was there in last year's renewal premium has dropped off, but it was never due as per the policy terms. Okay. Right? Because what we have filed with the regulator just says 5 premiums. The policy holder has paid 5 premiums and is not. So it looks like there is a tapering off. So it can be quite misleading in that sense, because it depends on what we sold last year and what was the number of premiums that we had to collect. So we were never meant to collect it this year. So it can be misleading in that sense. But 13% is not bad at all, because it gives rise to a 87% 13-month persistency.
Absolutely. Yeah. Also, when we look at the interest rate scenario at large, quantitative easing is something that is happening across the world, and at some point or the other, India will also see a rise in interest rates. Yes. Considering that most of your investments are into debt securities, how do you see that affecting your net worth, your embedded value, and especially the fund value of your ULIPs? Considering that the investment, the exposure of the ULIP portfolio has been rising from 51, I think it was 57% in this year. Yeah.
So our overall our assets under management of 1.06 lakh crores is a mixture of debt equity. About typically 60-40 is the debt equity ratio. And that really, so the impact of interest rates, we do have it in our sensitivity. On embedded value is not very significant. Neither is the equity markets. Even on net worth, because what happens on a unit-linked portfolio is it's a pass-through. So especially what ideal quarter is this quarter, in quarter 4, you will see that because of equity markets in the same period last year grew about 10.6% versus about this quarter grew about the 10.6% versus about 21, about 2x in the corresponding last year. And you will find that the unrealized gain has dropped by about 3,500 crores. You will find a mirror adjustment in the actuarial valuation, so it will be profit neutral. So it looks like it is a large shift in your income, but it is a neutral event for the insurance company. Only on other than unit-linked products, which would be like a non-participating products, there could be some impact on of interest rates. But even that, when you look at our sensitivity on embedded value that we have given yesterday, you will see that our embedded value is not very sensitive to movements, and that is the single biggest reason for that is balanced product mix. So if a particular product mix is heavily dependent on interest rates, like say a non-par savings product, something else will balance it out. Like a unit-linked product will balance it out.
Absolutely.
Yeah, and that is what results in the overall fundamentals of the business not really swaying too much because of market movements.
Correct. But you don't see any impact in the fund value of ULIPs or savings portfolio in that, like, you know, something that will really affect the business?
No, the fund value of unit-linked products will, if markets perform poorly, fund value will come off if the policyholder has a large exposure to equity. So that is something that we can't control. The NAVs will come off. But if the same unit-linked policyholder has a higher debt component or has a more balanced mix, then the impact of a fall in markets will be that much shock absorbed. Yes, to answer your question, the fund value is like any other industry that that has exposure to the markets, little that we can do about their own personal choice in terms of what their risk appetite is. But from the company's financials point of view, that is not a significant impact.
Correct. And also, by when do you see the ULIPs portfolio kind of shrinking to 50% as you had intended it to be from the beginning of Q1 FY18? You've been saying that we want a 50% exposure to ULIPs.
So typically that tends to happen. One is just based on the markets. Sometimes the pull of the markets is that it's difficult to curtail. More than curtailing it as such, what we would like to do as a strategy is that we would like to sell more profitable products to balance the fact that unit-linked products are being sought after. And hence are finding other parts like protection, and we've done well on protection as well. So you'll find both have gone up, and hence resulting in a post-overrun margin of 23.2%.
So what would be your outlook then for the next year? How do you plan to sustain the return ratios at 26-25%, which has been the case so far? And what would be a strategy to do that, if not pricing?
2-3 things. So in terms of new business margins, we will not write business that does not give us the kind of margins that will get us to these kind of levels. So we do end up saying no to a lot of business that we believe is either poor in persistency or intrinsically the product is not going to make you that kind of returns. And so you will see that we might not be the number one in terms of top line.
Yes.
Part of that reason is exactly this, wherein we would say no to a lot of business. So it is on an eye on profitability, and we have to find ways, and this whole digital and technology journey has been that we are able to reap some of these rewards. And, and not to forget all the new business tie-ups that we have, the number of partners that we have tied up with, and over a period of time, from being, just having probably 24 partners to over 130 bancassurance partnerships is not a small journey, I think, and that will help us continue to remain, to find these pockets of profitability.
All right, so that was the management of HDFC Standard Life with the outlook on their business prospects. The stock trading 2% higher on the back of an earnings beat. But with that, we're running out of time on this show, Trendspotting. But up next is Hot Money, so stay tuned in.